Welcome back to Midcap Radar. Well, as promised, Rajratan Global Wire is in focus. Remember, the company posted a good growth in profit as well as top line, but margins on a year-on-year basis compressed. Sunil Chordia, the CMD at Rajratan Global Wire, joins us now. Well, sir, thank you so much for joining us. Like we mentioned at the start, there has been a 15% volume growth, despite the fact that at the end of Q1, you had indicated that there were various uncertainties, especially related to tariffs as well as export markets not doing as well as earlier anticipated. So what drove the volume growth? And also, first, you give us a sense of how exactly business panned out, especially in the export markets.
Yeah, so, we had invested in Chennai in a new facility, which is up and running for last 1 year. And now we got major approvals in our Chennai factory from our marquee customers. And we are able to push more volume from that location, which has made a viable capacity available to us. Okay, so this has been possible only in the last quarter. And that is why we are able to sell more. Also, in the global market, we are getting more and more approvals, and there is a good growth in export market also for us.
So, Mr. Chordia, this Chennai facility, two-part question on this. You said in last 1 year it has been up and running and getting you more volumes. How much of the volume growth or how much volume came from the Chennai facility? Secondly, is it running at full capacity utilization? If not, by when will that happen? And would that mean more volumes coming your way in FY26 and FY27?
Yeah, so Chennai facility, as you know, we had invested into 50% of the actual capacity of our plan is to make it 60,000 tons ultimately. Current capacity is 30,000 tons per annum, and we are running at 60% capacity utilization. And we have also decided to now invest in the remaining capacity to make it 60,000 tons. And we are very confident that the next year we'll be able to use substantial capacity in Chennai.
Okay, we got that. So now, we've got Chennai out of the way, but let us talk about the EBITDA margins. EBITDA margins on a year-on-year basis have moderated. Now they're slightly northwards of 13.5%. Street is keen to know, when this can move upwards. What impacted the margins in H1 and H2? Do you have any tailwinds that can aid margin recovery?
Yeah, so if you closely look at the numbers, on a quarter-on-quarter basis, the margin has improved by 1%. Okay. From lowest 12.5% EBITDA margin in the last quarter, we have improved it to 13.6% margin. And this has been possible because of improvement in Thailand business. And in India, the margins will not improve because there is an excess capacity in the market. But for Rajratan, there is a special situation. We are in Chennai, and there is a substantial possibility of reducing our cost. As we improve the production there, our cost will come down. So that is another, possibility of improving margin from Chennai. So in coming quarters, you will see improvement in margin as well as improvement in tonnage from both our Thailand facility as well as India Chennai facility.
So you said there's overcapacity in the Indian market, but still the Chennai facility will allow you to improve margins as costs come down when production increases. So how much higher can the margin be because of cost reduction that you will see? And that 60,000 tons that you said you'll increase the volumes to, when will that come on stream, Mr. Chordia?
So, long term, we see that this business should come back to a 15% EBITDA margin. Exactly, I cannot tell you when it will happen in the next quarter or subsequent quarters. But the normal working will come to 15% EBITDA margin very soon.
Okay.
And sorry, on that 60,000 tons capacity, when does that come on stream for Chennai, Mr. Chordia? Will it happen in next fiscal or after that?
That will be operational from first quarter of next financial year.
Okay.
Okay. Sir, you've told us that Q1 was the bottom in terms of margins. Now, what we want to understand is how has pricing environment been, especially given extremely volatile input costs? And number two, we are short of time, sir. Give us a sense of how the export market demand is panning out, especially in the context of tariffs.
Yeah, so fortunately, tariff has not affected us. It has rather given us an advantage because there is excess tariff on China. And in global market, we are competing with China. And there are good news coming in from our marquee customers in export. So we are getting more and more approval from our multinational companies, whom we have been supplier for many years in India and Thailand. But now we are supplying to them. We have begun to supply them in Europe and
That is what I was going to ask.
North American
Yeah.
market. So that is the market which is growing for us.
So, Mr. Chordia, you are saying you're not impacted by tariffs. There are new capacities coming in Chennai, and that is something which could aid margins. 15% volume growth this quarter. What is the target for the entire year? And once the additional capacity comes in, what is the target for FY27? This is in terms of volume growth.
Yeah, so as I have been telling, we will have a volume growth of 15%, and we are close to that number, or we will achieve that. I am very confident. And we have an aggressive business plan for next year. So similar kind of volume growth you can see next year also.
Okay, thank you so much, sir, for joining us, giving us a sense of how Q2 panned out and what exactly you expect as far as the remainder
Thank you.
of 26 is concerned.